Okay, let's continue with part 2, projected growth. Step number 5, analyzing upside potential. The way that we analyze upside potential is we look at growth. We look at the production growth and we look at the resource growth. Also, there are three main things that value a company. Its production ounces, which are its current production ounces and its future production ounces. Its resources, current and future, and then the price of gold. And I'm looking at the projected growth, so I'm looking at the future price of gold, but the price of gold does value the company. So if you look at a company's current valuation, a lot of times the stock will not really have any value for potential price of gold going up. Sometimes a company will get a little bit of valuation for future production if they've given guidance, but a lot of companies do not. Now I want to look at resources, the different types of resources. So we have inferred, measured and indicated, which is M&I, and then proven and probable, which is P&P. Inferred production is unreliable. It's gotten from drill results and also from geology. Sometimes I'll actually do my own inferred production based on their drill results. If they haven't done a 43-101, just based, I can have a I can guess and come fairly close based on the length and the width and the depth of a strike zone. But inferred is unreliable, and the website, we have a default and we only give 50%. We're trying to value a company, use 50% of the inferred. And then the measured and indicated, we give 80%, and then proven and probable 100%. We're projecting future profitability. And you can change those. But again, the inferred resources are unreliable, and you can usually estimate about 50% of those could turn into measured and indicated. Measured and indicated are reliable, and those are obtained through a 43-101 report, which is done through a third party who they've hired. A company has to hire a company to do that for them. Hire a third party, and the third party has to, they're kind of like CPAs. They actually have to go out there and do a legitimate report. And if they think if the stock exchange thinks it isn't legitimate, they'll actually have them change it, make them go back and do it over again. So again, 43-1, the measured indicator, reliable. And then the proven and probable, the only difference between measured and indicated and proven and probable is a mining report, or what's called a feasibility study. So it's actually proving the economics of the resources, and those are considered reserves. So the proven and probable are reserves, so they're proven economic reserves, and measured and indicated are just reliable resources. The measured and indicated usually is inclusive of proven and probable. So usually to calculate the resources, all you have to do is add the M&I and inferred together, and that's your total resources. But you need to look closely and make sure if the proven and probable are inclusive or exclusive of the measured and indicated. So those are the resources. The other thing in regard to resources is the grade. For surface mines, I like to see anything that's greater than 1 gram. Anything that's greater than 1 gram per ton for surface, and I'm happy, I'm satisfied. But I will go down to as low as 0.5 if I see a project that is 0.5 or higher. I might like that. I might invest in it. A lot of investors think that those low grade resources they're not economic, but it depends. That low grade could also include zinc and lead and gold. and make it a very economic mine. So you have to look at the economics in conjunction with the grade. Even if it's 1 gram, if they don't have any base metals to go with it, it might not be an economic mine. And then your underground is going to be, higher than that. You really want about 4 grams per ton for underground, but they will go as low, they'll mine as low as 3 grams per ton for underground mine. So it can be a low grade underground mine as well. But anything that's 4, 5, 6 grams is actually pretty good for underground. And if you can get a surface mine, it's well above 1 gram, it's going to be very, if you can get a 4 gram or 3 gram per ton surface mine, those are very unusual. Those are considered high-grade surface mines. So that's your resources. And your recovery rate, I guess I mentioned recovery rate. You want your recovery rate to be above 75%, sometimes as high as 100%. It's never 100% recovery rate, as high as 98%. I like 90% or higher recovery rates. Anytime you get to 80% or below recovery rates, it's not good. To me, it's kind of like a lot of wasted gold, because it's just gold you're not going to recover from your resources. There's usually a lot of times there's a secondary metal, such as copper or silver. If there's a secondary metal, the recovery rates don't need to be that great. You can go down to 50% recovery rates for secondary metals is good. Sometimes the secondary rates are as low as 25%. Okay, sometimes companies give guidance, and sometimes you have to forecast growth. As a matter of fact, you generally have to forecast growth, and that's what I'm teaching you how to do with the future. What I do is a future market cap growth, and I do that to do a rating, and that's part of this presentation. But it's great when companies give guidance, especially, I remember back in 2007, First Majestic gave guidance. They were currently producing about 3 million ounces, and they gave guidance that they were going to produce 10 million ounces by 2012. So they were going to triple production in 5 years. And when companies give that kind of guidance, that's what you want, because it gives you a comfort level. And a lot of companies, I don't know why they don't like to give guidance. They don't want to mislead people, but the most they'll give you is guidance for the next year. And I don't really like that. I want, the more guidance I can get, the better. But if they don't give guidance, then you have to give your own guidance, and you have to forecast your own. Sometimes if they're not giving guidance for cash cost, a lot of times you're in the dark. It's always nice to get guidance, so you're always looking for that guidance. This is very important. Growth is often not priced in. Investors tend to ignore the future. For instance, future gold price or future production, what it's going to be in 3 years, and instead they wait for events before they buy the stock. For instance, they'll wait for the final permit. They'll wait for financing to get financing. They'll wait for construction to begin. Then they'll wait for production to begin. So a lot of investors, they won't anticipate. They won't put their money in and anticipate. Instead, they'll wait for events before. So the growth isn't priced in. And so this growth, this production growth that's going to happen, often is not priced in, so you can anticipate it, and that's where you can make money. Several factors can hurt the valuation, such as the location. Of course, we went over that. Any location that investors don't want to invest in, the stock just is going to languish. It's not going to do well. Management, especially if a management team isn't executing, investors will run from it. Hedging, if companies hedge too strongly, a lot of companies now are hedging, minimally. They'll hedge a little bit on debt. They don't hedge, real harshly. But you got to watch for some of these hedges. If they're real, they can do some really, poor hedges. If they're going to hedge, for instance, all the silver production. I've seen companies do that the entire life of the mine, silver production. That's just I don't like that, especially when silver could go to $50, $100 an ounce. Why are you hedging all of it? And sometimes they'll hedge 25% of the gold production. That can be real significant. So watch for hedging. High cost, high cash costs right now are hurting because we have a low gold right now. Gold's right around $1,300. So any stock that has high cash costs is getting hammered right now because they're not profitable. So look for that. Political risk, any perceived political risk. Right now, a lot of stocks in Africa have perceived political risk, which hurts the stocks. Financial weakness, if you have a lot of debt, it's going to hurt the stock. I see a lot of stocks that have crashed, 80% plus because they don't have a good balance sheet. If you have a lot of debt and you're not profitable, a lot of investors think you could go bankrupt, and that really hurts. So you want a strong balance sheet. Permit issues. For instance, I invested in a company and they had an opening pit mine next to a town, and the town basically will not allow that final permit. So it's been 5 years and they haven't been able to get their final permit. So permit issues can happen. Taxation hasn't been an issue. Energy costs. Anytime price of oil goes up, energy prices go up, that's going to hurt the stock. And then, of course, the black swan events. For instance, Hecla Mining, all last year had a mine closed down. The stock dropped by 30% just because of one mine going down. So black swan events can hurt. Timeline risk, market cap. So the timeline risk. The timeline risk is how long it's going to take for cash flow to materialize. So the timeline risk is, for instance, the company right now is drilling, but how long between now and when you get into production? And there's a difference between producers and non-producers. For producers, the timeline isn't as serious, but for a non-producer, because the producer can wait, basically, they're going to have cash flow, and eventually that mine will come online and help the stock. But the non-producers, they don't have any cash flow. So how long are you going to wait? What's your comfort zone? You want to wait 1 year to 2014? Can you wait till 2016, 2018? Personally, my horizon, what's your investment horizon? My return horizon is 3 to 5 years. I don't want to go. So if they don't have any cash flow until 2019, that timeline risk is too long for me. I don't want to wait 6 years for cash flow. 6 years is just too long of a wait. That's too long of a horizon. So understand, when you look at a stock, get an idea of when the stock is going to go into production. All stocks follow the same steps. They all have to go through the same steps, and they all have you have an idea of how long it's going to take. For instance, once they do a preliminary, first they start the mine. They start the drilling. They do phase 1 drilling, phase 2 drilling, and then they'll do they'll do a resource estimate, 43101. Then after they do the resource estimate, they'll see where they're at. They usually drill some more. They'll do an updated resource estimate. Then they'll do a PEA, a preliminary economic assessment, just to see if it's an economic mine. Once they know it's an economic mine, then they'll spend the money to do the pre-feasibility study. Then from the pre-feasibility study, then they'll do a feasibility study. Or sometimes they won't do a feasibility, they go straight to financing, and they'll use the pre-feasibility study. But a lot of times they'll do a feasibility study. Once the feasibility study is done, they'll do the financing. Then they'll do the permitting. Sometimes there'll be a little crossover. When they're doing the feasibility study, they're also permitting. Once they finish the permitting, they get the final permit, then they'll do the financing. Sometimes there can be crossover. They'll do financing, permitting simultaneously. Once they get the financing and the final permit and the feasibility study, then they can start construction. So the timeline usually is about 5 years from the time they do the first 43101 until they go into production. Anywhere from, the fastest I've seen it is 3 years. So 3 to 5 years. And it could be 3 to 6 years actually. Okay, the market cap. So the size is important. We've had a big correction here, 2012 and 2013, and so you have a lot of stocks that are under 25 million, which I would consider, very high risk stocks. And however, a lot of companies right now are valued anywhere from under 25 million that I don't think have high risk. They've just crashed because the market has had this incredible correction. So it's an unusual market right now. But usually, usually you want to invest stocks that are under 25 million. Well, for me, I like to go from 25 million to 150. Wait till it gets to 25 million. Wait till they kind of prove themselves. Just be a little patient. But currently, there's a lot of stocks. I'm not going to be patient. I already know they're valuable. They've already been. These are companies that were 100 million and now they're down under 25. But companies that are on their way up. They're on their way up. You can just be patient and see how they unfold, and then you can jump in when they get to 25. So my sweet spot's about from 25 to 150, but you can have your own. The risk, you can go for low risk stocks, for instance, mid-tier producers, say between 200 million and 500 million. Well, these companies probably aren't going to be 10 baggers, but they could easily be 3 to 5 baggers, and the risk can be low. And then high risk is your low end, real low market cap, say between 5 and 25 million. And then I think that you want to avoid the really large cap, say above 2 billion, even above 1 billion, because what's the return going to be? Unless you're looking for income. If you're looking for income, then the market cap doesn't matter. It's what the dividend payout is. But you can look, I've analyzed most of the majors, and I tell you which ones are the better dividend plays, and you can look at the various dividend plays. And some of these are outstanding income investments. For instance, Newmont and Barrick. I mean, they're trading so cheap right now and they're paying about a 2% dividend. So if you invest, let's say you invest 10,000 today, and they're paying 2%, and then they triple in value, you're going to be getting a 6% return on that $10,000 if the dividend stays at 2%. And then if it triples, and then if their dividend goes to 3%, you'll get a 9% dividend on that $10,000 investment. So there's a lot of good income plays out there right now. Okay, good chart, good buzz. So you always want to check this when you're getting ready to do an investment. You always want to check the stock chart, and you want to see how it looks. You want to look and see, a lot of these companies right now have a waterfall. Since 2010, all they've done is just go down, 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 and they're just bouncing on the bottom right now. So those stocks are, they're at the bottom. They're basically ready to bounce off the bottom, ready to take off. And then some stocks you consider they're kind of flatline. They went all the way to the bottom. They just stayed there. And so they're I use the term coil. They're kind of coiled. They're ready to explode upward. So you want to look for those. You want to look for companies that have not broken out yet. So you want to look for good entry points. Is it a good entry point? Stocks that have went up. If you see a stock that has risen, maybe it's not a good entry point. Maybe you want to wait. Is a stock at a high? If it's at a high, it might not be a good entry point. And another thing you want to look for on some companies is, has there been a parabolic move? Once a parabolic move happens, you missed it. There's been a lot of companies that have had their parabolic moves. I mean, companies like Gold Resource Corp or First Majestic. I mean, these are companies that they've had their parabolic move already. You want to look for companies that have not made their parabolic move yet. So always look at the chart. Other checks. Does a stock price consistently move with the gold price? For instance, Tanzanian Royalty Company. That company always moves with the gold price. Usually outperforms the gold price. So you want to look for stocks that, when the gold price goes up, and say 2%, look at the stock price and see if their stock price went up more than 2%. Because those are companies that, those are strong companies basically. If gold goes up 2% and your stock doesn't move at all, it's not really a good sign. But again, it could be for a number of reasons. You're waiting for your stock to For instance, get more drill results or get a PEA out or something. And then how does it compare to its peer group? You don't want to invest in the dogs in your peer group. You want to invest in the stars, right? So if you're investing, if you're getting ready to pick a stock, you want to compare it to 2 or 3 companies that are similar. And you might want to wait and see how those stocks are how they're performing. So you can pick the best one in the peer group. And then, are other people buying it? Right now, Caden Resources, for instance, everybody's buying that stock. It's been going up. It's went up 85% in 2 months. So sometimes it's good to be with a stock that other people like. And then if they're not buying it, why not? A lot of stocks have just totally crashed. Get an idea of why they're not buying it. You can read the blogs and read the forums and get an understanding. Okay, cost structure financing. So ideally, you want low cash cost. So a good way to figure out what a low cash cost is divide their cash price by the gold price. So let's say the gold price is $1,500 to use since we're going to use 1/3. So if you divide it by 1/3, you get $500. So at $1,500 gold, anything that's 500 or less would be low cash cost. 1,000 would be right on the border. That's 2/3 of 1,500. So 2/3 is the high structure. So you really wouldn't want any cash cost over 1,000 at $1,500 gold. And we're at $1,300 gold, so we definitely don't want anything over 1,000. But I think we're going to go much higher. So if you go at $1,800 gold, then the high cash price goes all the way up to $1,200. So I like to $1,000 or less on the cash cost because I think the price is going to go up. But right now, if you're looking in the near term, you really want to have cash costs around 500-600 would be really low. Offsets can lower your cash cost. So I always like to see good offsets, especially if your main metal is gold. I like to see silver offsets, or vice versa. If silver, I like to see gold. But if you're using zinc, lead, and copper as your offsets, don't expect base metal prices to go up in the future or maybe have demand. Don't depend on it. So I'm a little conservative when my offsets are base metals. I don't really like it when companies are using 50% of their their offsets are base metals. Scorpio Mining is like that. Hopefully they'll be okay, but they were like 50% of their metals prices are base metals. So now, in addition to your cash cost, you have additional operation cost, and this between them you get all-in cost, and you want your all-in cost to be below the price of gold. So right now gold's at 1,300, so you want your all-in cost to be at 1,000 or less, and you're okay. But if your all-in cost today are at 1,300 or higher, you're losing money. So you have to, on my website, I always pad the cash cost with additional operation costs. And right now, it's about $1,200 is about the average. So we're not below at 1,300. You're still a little bit higher. If it was at 13 and the average was another $100 higher, then these companies would all be losing money. So some companies are losing money, but on the average, I think 1,300 you still have profit. Additional hidden costs include debt and servicing and hedging. So if you have a lot of debt, that debt has to be paid back, and so that's going to be part that comes right out of I consider that a cost, because it's not going to be free cash flow. So we're looking when you add these two together and you subtract the price of gold, that's going to be your free cash flow. So debt takes away from your free cash flow. Hedging, if a lot of your gold is being sold at a lower price, then you're going to have to sell part of your gold. That's not going to be free cash flow again. And then exploration programs are spending money for expansion. That's going to diminish your free cash flow. and that's a big chunk of it. And then also growth. Some companies will, continue to buy other companies with their cash, which takes away from your free cash flow. CapEx financing. So if you have a big CapEx, that right now it's really difficult to finance large CapEx, and so often hedging that can hurt the value of the company, or they might have to sell the company. Or sell the property, even sell the company if their CapEx is too high. They can't get financing, and for that CapEx, then they have a problem. And a lot of companies right now are having trouble financing some of these projects that they have. So right now, I like to see CapEx below 100 million on companies' first mines, so that they can just get into production. If they can get into production, then their next CapEx can be higher, and then they can expand production down the road. But if their CapEx is $200 million or higher, and it's their first mine, it can be tough. And a lot of times they have to hedge to get the financing. Oxides versus sulfides. So your oxides is your surface ore, and the surface oxides are actually a very fine grain, and so they're very much cheaper to mine. So and they don't necessarily have higher recoveries. A lot of times the sulfides, the underground sulfides, are higher grades, and those usually have higher recovery rates. But the oxides can be very cheap. So if you have a low-cost oxide surface mine, those can be heap leached. So you can heap leach them, and they're very cheap to mine, low CapEx. So a lot of times I look to see, is this a low, they have a lot of, surface oxides. Cash debt. So cash is king in the mining business. And the reason why cash is king is because cash allows you to do your internal financing, so you can basically finance your growth yourself. You're not depending on debt for growth. You can use your cash for growth, and you can use your cash to buy other properties. You can use your cash to buy other companies. So yeah, cash is your friend in this business, and it prevents you from having to do dilution. So if you're a producer and you're profitable, and you have, say, 100 million in cash, you're sitting really pretty. You're profitable, you have cash, you have more cash flow coming in. You can use that cash strategically. You can use it to grow as you want to grow. So in the mining business, you want to basically build up your cash hoard, eliminate your debt, and then grow strategically. Investors know this too, so it's going to really push that market cap higher when you have that real solid balance sheet. So debt is not, but even though you have debt on your balance sheet, it's not always a problem, because debt is used to build mines, and it's normal. But you want to be able to pay that debt down and get rid of it as soon as you can. So pay it back quickly. So if it's an economic mine and they have $50, $100, $150 million in debt, if they have cash flow coming in, they can pay that debt back and pay it off in, say, 3 or 4 years, clean up their balance sheet. It's not necessarily a problem. The issue is, what is the burden? How fast are they paying it back? But know this, investors do not like debt. Remember when I said they don't like to anticipate the future? So they don't anticipate that debt's going to be paid off. So the stock can really get hammered if they don't have a real clean balance sheet. To me, a good balance sheet is at least 2 to 1 cash to debt. So beware of the burn rate. A company might be sitting on $5 million in cash, but they can burn through that in 1 year if they're drilling a lot. So beware of the burn rate. How much cash are they going to burn through in 1 year? Because once they're out of their cash, they're going to have to dilute if they're not a producer. So beware of the burn rate and prepare for dilution, especially if a company has a share price of, say, less than 25 cents. Shares less than 25 cents, they go to raise money. It's really going to, they have to issue a lot of shares. But once they get to 50 cents or $1 a share, it's not so painful to raise cash, because they usually only need to raise, anywhere from $2 to $5 million a year to stay in business and to keep the drills turning. Non-producing companies have no cash flow. Always be aware of that, because they're going to have dilution. And companies have to issue shares and warrants to raise cash. Okay, so that's part 2. We'll do one more and we'll be done.